Well, the official title of the chapter, as you see, is Using Financial Information and Technology. It's really accounting. We're really learning about financial accounting this week. So we'll learn what financial reports accountants make. Again, if you're a business major, you'll take financial accounting, which is business 1A, and then you'll take managerial accounting, which is business 1B. In financial accounting, it's all about making financial statements for mostly people that are outside the organization so they can know what's going on with the company's finances. So that's a huge part of financial accounting. We'll learn what is the difference between a public accountant and a private accountant. We'll look at federal legislation related to accounting. We'll learn about the accounting cycle. And for some reason, this textbook's accounting cycle has only 6 steps. In accounting courses, you learn 9 steps to the accounting cycle. So you'll learn both. You'll learn the intro to business definition of the accounting cycle, as well as the more official version. We'll learn what the balance sheet is. A couple of you mentioned that earlier. That's one of the financial statements that businesses produce in order to help people outside the organization understand the value of the company. There's also the income statement that tells how much profit or loss the company had, and something called the statement of cash flows. And you guessed it, it tells how much cash flow the company had during that period of time. We'll learn about different financial ratios that can be used to help simplify accounting information. So it just makes it easier to talk about companies when you can talk about their ratios and not all the details that are on the statements. And we'll look at trends related to accounting. So I always find it interesting to think about accounting because, you know, unless we know somebody who's an accountant, most of us don't have a lot of experience in business accounting. We really don't know much about it. Just that accountants are people that sit behind a desk, you know, with the computer in front of them and crunch numbers. And that's partly true, but not really. I mean, there's a lot more to accounting than that. And if you think about it historically, some of the very first writing we have records of, I was going to combine records and evidence into one word, and it would have been revidence. That's not a word. Some of the very first writing we have evidence or records of is accounting information. Back thousands of years ago, people started writing things down, and it wasn't, you know, LOL. It wasn't, hi, my name is Kraft. It was, oh, this person bought 5 sheep from that person. Or this person owes, whatever, 5 pieces of stone to that person. It was very basic record keeping, and it was accounting. And it has evolved over many centuries. In Italy, the common approach, the double entry bookkeeping system that is used around the world for accounting purposes, was developed by a monk in Italy. And it's kind of complex, but it has a certain elegance. Once you understand it, it makes perfect sense. But it takes a while to really understand our accounting system that we use. It's very basic math that gets used in accounting, but it's different from math you learned in other math classes. Because in accounting, the way we do math is we use these 2 columns. And in one column you add, and the other column you subtract. But where it gets confusing for students is it depends what we're talking about. Sometimes you add the left column and subtract the right. Sometimes you add the right and subtract the left. And they're called debits and credits. And so that's why a lot of people take accounting, even if they've taken advanced math classes, and they say, I don't get it. This doesn't make sense to me. Well, anybody can learn it. It does just take time. You have to get used to it. And you'll see as we go through it, there's a lot of different terminology in accounting that we don't use in our everyday conversations. And so accounting is often called the language of business. You want to talk about how profitable a business is, you use terms like working capital, debt to equity ratio, earnings per share. These are not everyday common words. But by studying accounting, they get more familiar. There are also concepts in accounting that are not necessarily what you would imagine. They're not necessarily intuitive or logical, but you learn them over time. So the basis of what accounting is somebody gathering up information about financial transactions. Today, a lot of that is done with computers. Most of it's done with computers. But it used to be somebody had to write it down. Again, this person bought 5 sheep from that person, right? That would be a financial transaction. And you can turn it into a report, a statement that says, this year, this company had $2 billion of revenue and $1 billion of expenses, right? That's the kind of information you'd find on a financial statement. And then investors, analysts, the IRS, anybody who wants to can look at these financial statements and understand what's going on with this company financially. So that's really the basis of what financial accounting is all about. Are there any questions at this point? How many people here have taken financial accounting or are currently taking it? Nobody? Oh, Ulysses? Yeah, that's right. You're my financial accountant. And Daisy, that's right. So again, if you're a business major, you will be taking that class as part of your program. And then you go on to managerial accounting. If you're not a business major, I was just actually looking this up yesterday. Financial accounting, which is business 1A, does count as a general ed requirement, but it is not part of the Cal GETC, which is the Cal State general ed requirements. So if you're not a business major, you're thinking about taking accounting for general ed purposes, talk to your counselor to make sure it's going to meet your particular needs. But if you are a business major, it's part of the required courses to graduate with the associate's degree in business here. So let's talk about the difference between financial accounting. Again, that's what you take first, and that's really what we'll be learning about this week. And managerial accounting, which you would take after financial accounting. And that really has more to do with preparing reports for managers. So in financial accounting, you learn how to create financial statements that, again, are primarily designed for people outside the organization. So there are a lot of rules that have to be followed. Because if companies could just say, hey, we made $10 billion in profit, and there were no rules that they had to follow to get to that number, then companies could just make things up, right? But instead, for those documents that are shared with the public, there's a very precise set of rules that has to be followed. And that's one thing you learn about in financial accounting. And these are examples of some of the different financial statements that could be produced. We'll get more into each of those later on. Now, in managerial accounting, again, you're making reports for managers. They work inside the company. And you don't have to follow a specific set of rules for that. Because that information is not being shared outside the company. It's only for internal use. So you can basically just give the managers whatever information they need. If they want to know how much in sales they have, what are their production costs, or anything else, and they want it for last month, or they want it for the last 3 years, whatever they want. In managerial accounting, you give them that information. Right? There are some standards for how you do that, but nobody can, police your managerial accounting. If you do not follow the rules in financial accounting, and you put out information that is intentionally wrong and deceives investors or anybody else, that could be fraud. It's pretty serious. But in managerial accounting, you don't have to worry about it. So, any questions or comments on anything at this point? Okay. So, the rules that I was mentioning are called GAAP. GAAP stands for Generally Accepted Accounting Principles. And most companies in the United States follow GAAP. If your company does a lot of international business, you might be able to follow, it's not up here, but IFRS, which is IFRS. Those are international financial reporting standards. But most companies follow GAAP. So in the financial accounting course, that's what we learn is GAAP. GAAP is updated and, it was developed and is updated by the FASB, which you see here as Financial Accounting Standards Board. So they're responsible for GAAP. And the international standards come from the International Accounting Standards Board. Now, if you work for a company as an accountant and you do accounting for that company, so you help them keep track of their sales or their costs, you're what's called a private accountant because you're only doing accounting for that one company. If you're a public accountant, that means you're doing accounting for multiple companies. Some people have their own accounting business as a public accountant. So people come to them maybe for help with taxes, maybe for help with their business accounting. And those are public accountants. Some people, once they get their degree in accounting, they go to work for one of these 4 big accounting firms. They're called the Big Four. So Deloitte is one of them, Ernst & Young, KPMG, and then PwC, often they're referred to by their full name, PricewaterhouseCoopers. Those are the biggest 4 accounting firms in the United States, perhaps in the world, but they're huge. And if you go to work for one of them, you will be doing accounting for their clients. So they'll send you out and say, hey, we want you to go down and do some accounting for Disney this month. And next month, we're going to send you out to Exxon. Next month, we're going to send you to Sony, whoever. So there can be a lot of travel, not necessarily, but for some people that work for the Big Four, they travel a lot, maybe even to other countries and do accounting in other countries. These jobs pay pretty well, very well, amazing benefits, but they do expect a lot of hard work. I know people that, have worked in those industries. It's hard work, but it can be very rewarding. So that's one possible career track if you go into public accounting and work for one of the Big Four. That it can be pretty lucrative. You could also stay locally and work for accounting firms locally. There are some mid-sized accounting firms here in the Monterey County. There are small accounting firms. So there are also people that get a degree in accounting, they go to work in government. And right here at Hartnell, we've got an accounting department. Those jobs, I can tell you, they pay pretty well, excellent benefits. You get a pension. It's hard to find a pension unless you work for a government entity. So there are a lot of job opportunities. Some people get an accounting degree and they go work for the FBI or the IRS or the IA. So there's a whole field called forensic accounting that is where you look through the financial records to figure out how the money got stolen, who stole it, who committed fraud. So that could be a whole aspect of accounting. So any questions or comments on accounting careers, types of accountants, anything? Okay. All right, so I mentioned there's an accounting cycle that for some reason this textbook says has 6 steps. It really has 9 steps. So the first step is to analyze transactions. Again, somebody has to gather up all the financial transactions. A lot of companies just do it automatically where the cash register records every sale. When they receive shipments from their suppliers, they scan it, it goes right into the computer system. So that would be one way to gather up those financial transactions. But in a smaller company, that might be done manually. So you take all those financial transactions, they get recorded first into what's called a journal, which is just a list of all the transactions. And then they get copied over to individual accounts in what's called the ledger. So every account, like cash, would have its own record of all the cash that came in, all the cash that went out. Or you might have an account called sales that shows all the sales that were made. So those are the first 3 steps. And the 4th step is what's called a trial balance. You just take the total from every account and you list it in a document. And then remember I mentioned earlier in our accounting system, we use these 2 columns, we call them debits and credits. Well, the neat thing about the accounting system that we use is it's got all these checks and balances built into it. So when you take the balance of every account and you list it on a trial balance, your debits should equal your credits. And if they don't, then you know that there's a mistake somewhere. So that's why it's called a trial balance, to make sure your debits and credits balance. Now, those are the first 4 steps. That is correct. In real life, there are 2 more steps that you would then follow before you make your financial statements. But in our textbook here for Intro to Business, it says the next step is your financial statements. And then it says we would analyze those statements. And that is true. There are some steps after the financial statements as well. So when you get to financial accounting, whether you take it with me or with somebody else, and you learn that there are 9 steps, just remember, that's right, this textbook is wrong, okay? But in case it comes up on a quiz and it asks you how many steps are in the accounting cycle, according to this textbook, it's 6. All right. I already mentioned that computers are used a lot in accounting. It used to be, it would take a huge room full of people to keep track of accounting for one company, you know, if it was a large company. And now it might take just a couple people because everything's been automated with software, computerized systems that track inventory and track sales. So computers have had a big impact, and that trend is probably going to continue. So you might be wondering, well then, why will there be a need for accountants in the future? The role of accounting has shifted. An accountant is not so much the person who is tracking things and calculating. Instead, an accountant today is somebody that can explain to the CEO why the company has low working capital or why it has a high debt to equity ratio. somebody who understands how these numbers were calculated by the computer and what they mean and what its, implications are for the company. That is really the role of the accountant. More knowledge and understanding and not so much math. So let's see where we're at time-wise. Let's cover this one more slide, then I will show you a video. Okay, as I mentioned, accounting is based on concepts, and some of them take a while to kind of grasp. For one thing, we've got 3 basic types of accounts that we use in accounting. Some accounts are assets, some are liabilities, and everything else is a form of equity. Now, again, these are not words we tend to use in our everyday language, and if we do happen to use these words, it might be in a different context. An asset is something that the company owns. It could be physical things, like products, materials, supplies, equipment, buildings, all of those would be assets. And again, we can relate it to our own personal finance because we all have things we own, right? Our clothes, our books, our maybe car. These would also be assets. For companies, we use the term liabilities for debts. So if a company borrows money, it has a liability. And companies will do that. They'll borrow money from a bank, they'll borrow money from bond holders. Did we talk about bonds yet? Getting my classes mixed up. A little bit? Yeah, okay. So I think I mentioned that when somebody buys a bond, they're actually making a loan. And the company issuing the bond is borrowing the money. So that would be another type of liability. And then there's equity. So equity, again, is everything else. I think of equity as the value of the company. So let's say you had a company that had $1 million worth of assets, and they had $800,000 worth of liabilities. So what is that company really worth? If you took the assets and you subtracted the liabilities, everything else is the equity. And that would be the value of the company. Now, part of that equity is stock. It's what the stockholders, this is assuming it's a corporation, it's what they have purchased, the portion of the company that they have bought. But then there's also some equity that is not stock, and this we call retained earnings. So retained earnings is, again, not a word we use every day, but it's pretty simple. It's earnings that the company had that it retained, that it held on to. We can see that revenues increase retained earnings. I think that word revenue has come up. Can somebody tell me what's meant by revenue?
Money that's generated?
Yeah, the money the company generates when it sells its product or service. So we could think of the revenues as their sales income. The more you sell, the more that increases the equity in the company, the value. On the other hand, companies have expenses, right? They have to pay for employees, they have to pay for electricity, taxes, all kinds of expenses. And that reduces the value of the company. And another impact on equity is when a corporation takes some of its profits and gives it to the stockholders. We call that dividends. So you're taking value out of the company and giving it to the investors. And then it becomes their personal money, right? It's no longer part of the company. It's now their money. So that is the one of the fundamental concepts in accounting. And we call this the accounting equation. So you see it says assets equals liabilities and equity. Okay, that's a fundamental concept. So just like I told you, your debits and credits always have to balance. your assets always have to equal your liabilities and equity. Those are always going to balance as well. And after we view our video, we will talk about the balance sheet, where you indicate these are the company's assets, and then these are their liabilities and equity. So that whoever's looking at that balance sheet, again, understands what's happening with the company financially. But we will come back to this. So any questions at this point? Okay, for this summer, we have one section that is going to be taught by instructor Peelman. It's a completely online section. I'll double check right now. I think there may already be a waiting list, but let's double check. Okay, let's get back to our chapter. So with the 5 minutes or so that we have remaining, we're going to go over the balance sheet, one of the main financial statements that accountants produce. All right, so where we had left off, I talked about the accounting equation, right? That the assets are equal to the liabilities plus the equity. And that is actually the basis of one of the main financial statements, the balance sheet. And so we see an example of a balance sheet here. Now, even if you're not going to be an accountant someday, if you are going to be in management or an executive of some business or start your own business, you need to understand how these accounting statements work, so that you can talk about how your business is doing and you can understand how your business is doing. Even as an employee, it's a good idea to look at your own employer's financial statements if you have access to them, so you can understand what's going on in the company. You could even check out the accounting statements for Hartnell if you want to see where the college is spending money, where its money is coming from. That's public information. You can look it up. But if you don't know how to read the statement, then it doesn't mean anything, right? So a balance sheet will tell you what a company owns, its assets, its debts or liabilities, and whatever equity or value exists in the company. So the first section is assets. Now this is a fictitious balance sheet for a bakery. And the balance sheet is produced as of a particular day. So you know on that date, these were the assets, these were the things that the company owned. Now I'm going to go through and explain this. It might not all sink in, but again, when you get to financial accounting, these are the kinds of things you're going to be learning. And again, it's like a language, right? You're learning some new terminology, the language of business. So as far as assets, the first category we have here is current assets. In accounting language, current means within a year. So these are assets that we are either likely to use up within a year, or if we needed to, we could turn those assets into cash. So cash would be in that category because it's already cash. Marketable securities would be stocks or bonds that the company owns in other companies. And they're planning to sell these within a year, which is why they're under the category current assets. Then we have something called accounts receivable. This is money that we expect to receive from our customers that haven't paid us yet. So these are customer accounts where we're expecting to receive a payment at some point this year. Now, the next thing here, it says less allowance for doubtful accounts. That means there are some customers that probably aren't going to pay us. So if we're expecting $45,000 from our customers, except $1,300 that, these customers are flakes and they're just not going to pay us for whatever reason, then we really think we're going to get the difference. So here we see two columns, right? Basically, we have some of the details here, and it's totaled up over here. Now, I told you before about debits and credits. This is not debits and credits. We don't have to get to that in this course. On the financial statements, you do see multiple columns, but it's just details and subtotals and totals, okay? Not debits and credits. This company also has some notes receivable. A note is another word for a loan. So the company has made a loan to somebody, and they're expecting to get that money back, right? So they're going to receive $5,000. That is considered an asset. They also have some inventory. Inventory would be products that they're ready to sell. It could also be some raw materials that they're going to use to make products. And that falls under the same current category because you don't want your inventory sitting around for a year. You want to sell it pretty quickly. So if we add up all of these current assets in this column, we get a total current assets. It's not that hard to understand if you understand the terminology. Any questions so far on this part of the balance sheet? Okay. Then we have some longer term assets. Notice they're called fixed assets. Fixed asset is going to be around for more than a year. Think of it just like it's fixed in place. It's not short term. So they have some bakery equipment. Right? That makes sense. They're a bakery. And then they've depreciated that equipment. With long-term assets, you can't count the expense of the asset all at one time. In most cases, the IRS requires that we spread out the cost of that asset over many years. So that's called depreciation. So in other words, they have $56,000 worth of equipment, but they've been able to count 16,000 of that as an expense. And so really the remaining value of that equipment is 40,000. Okay, we call that the book value. Then we have some other long-term assets, furniture and fixtures, also with some depreciation. So we see the book value of the furniture and fixtures. If we add that to the equipment, we get our total fixed assets over here. So then we have some more long-term assets. A trademark. This bakery maybe has a trademark on their name, so that if somebody else uses their name to make bakery products, they could sue that company. That trademark is not a physical thing, right? It's intangible. So it goes under the category intangible assets. There's also something called goodwill. This is when you purchase another company and you feel that that company is worth more than what you paid. No, I didn't say that quite right. You feel that the company is worth more than the technical value of the company. That extra amount that you were willing to pay is called goodwill. So that is also an intangible asset. So we see if we add those together, we get total intangible assets. Then we have this total assets. Now, if you notice here, again, the math is not that hard in accounting, it's the concepts. So this total assets includes these intangible assets, and it includes the fixed assets. But if you just in your mind, you add these together, they do not equal this number. So what's missing? How did they get to that total? What's that? Good thinking. But if you remember on the previous slide, there were the current assets, right? That's part of the total. So the current assets plus the fixed assets plus the intangible assets makes up the total assets. Okay, so that's the assets portion. Oh, we're over time. We'll cover the rest later. Sorry about that. Again, feel free to take a cookie on your way out.
We didn't want to interrupt.